If two mining pools could collude to control a network, is it still decentralized? And what does it say when a single whale selling just 10% of their stash could wipe out the top 5% of the order book? Today we're talking about Caspa, where a Gini coefficient of 0.89, an HHI of 3,150 among the top holders, and a liquidity-at-risk score of 1.85 all point to a simple, unsettling question. Who really holds the power? Hello and welcome back to our Kaspa Special, your in-depth look at Kaspa ecosystem. I'm Jamie, and with me is Alex, who's been buried in a fascinating new analysis about Kaspa's on-chain wealth concentration and systemic risk. Alex, this report is dense, data-heavy, and honestly, eye-opening.
It really is. The report examines Caspa from the ground up, the protocol design, the token issuance, the mining landscape, and then the economics you can actually see on-chain once you cluster addresses into real entities. The take-home? Despite Caspa's fair launch ideals and some very clever engineering, wealth and hash rate are highly concentrated. That gap between philosophy and current reality is the story.
And we should say, to situate listeners in time, we're recording on Saturday, September 13th, 2025. The past year brought explosive on-chain activity in Caspa. Lightning-fast transactions, KRC20 token mania days with absurd throughput. And yet, the concentration signals kept getting louder. So let's set the stage.
Caspa is a proof-of-work project built on GhostDAG, a block DAG variant that allows many blocks to be created and confirmed in parallel. Think of it as a multi-lane highway instead of a single-lane road. The design reduces orphaned blocks, lowers variance for miners, and supports very high throughput with tiny fees. Economically, that's supposed to broaden participation, but when you combine efficient plumbing with industrial-scale ASIC mining and liquid centralized exchanges, you can also supercharge the impact of a small number of big players. That's the tension we'll explore.
Let's roll into the official story. What did Kaspa promise at launch, philosophically, economically, technically?
Kaspa's founding ethos is the textbook version of decentralization. No pre-mine, no ICO, no founder allocations. The entire supply enters circulation through mining. Period. On the tech side, GhostDAG aims to keep the network secure while making block production parallel and fast. High throughput, low fees, and reduced luck variance are meant to level the playing field for miners and users. The monetary policy, called the chromatic emission schedule, smoothly reduces rewards every month, halving on a yearly cadence. The intent is a predictable, graceful glide toward max supply, without sharp cliffs.
So, fair launch, high performance, predictable monetary policy, textbook decentralization. Where does the discrepancy begin?
With who actually holds the coins and who actually drives the hash power. When you move past addresses and analyze at the entity level using UTXO clustering, you find a very different picture. The wealth distribution is heavily skewed toward a small cohort of whales. Some are exchanges holding customer funds, some are industrial miners, some are early miners who accumulated cheaply. On the mining side, hash rate is concentrated in just a few pools. And then you layer market microstructure on top. Thin order book depth relative to the biggest whales, plus structural sell pressure from miners paying power bills. That's how you get a Gini of 0.89, an HHI of 3,150 among top entities, a high liquidity at risk, and a high miner sell pressure index. The ideals collide with the current economics.
Theme 1. Wealth concentration and ownership. Before we get to the headline numbers, walk us through the methodology. Addresses aren't people, right?
Right. Caspa, like Bitcoin, uses the UTXO model. A single economic actor can control thousands of addresses.
If you measure inequality by addresses, you're basically fooling yourself. The report clusters addresses into entities with the common input ownership heuristic, also called co-spending. If a transaction spends multiple inputs, the private keys were likely controlled by the same party, so those input addresses get merged into one entity cluster. The process is iterative. Scan transactions, merge clusters when you see co-spends, repeat until no further mergers occur. You still have edge cases. Privacy tools can muddy the water, but on Caspa, they're not yet dominant. Net-net, you get a much truer map of who actually controls the coins.
Okay, Alex, the report heavily features the Gini coefficient. Before you give us the number, can you set the stage? What exactly are we measuring here, and why is it critical?
We're measuring how uneven the distribution of KAS is across real economic entities. Gini runs from 0 to 1. 0 is perfect equality, 1 is perfect inequality. It collapses the entire Lorenz curve, how cumulative wealth compares to cumulative population, into a single statistic.
And the number?
0.89.
Oof, that's high.
Very. Think of a Lorenz curve that hugs the x-axis nearly all the way to the right and then shoots up like a hockey stick. That's what 0.89 means. The vast majority holds very little. A tiny sliver holds a lot.
So, what are the second-order effects of that? What does a 0.89 Gini actually imply for Caspa's long-term viability?
First, price discovery becomes more fragile. When a small number of entities control outsized supply, their decisions disproportionately move markets. Second, governance by norms, what we might call the social layer, ends up relying on the goodwill of whales. Third, it amplifies the incentives and the means for strategic behavior, coordinated distribution, liquidity games, and timing around speculative spikes. The tech may be decentralized. The power to set prices is not.
Give us more color with concrete distribution tiers. Who holds what?
Entity-level tiers show the shape clearly. The single largest entity, a centralized exchange custodian, controls on the order of 1.87 billion KAS, roughly 7% of circulating supply. The top 10 entities together hold about 4.91 billion KAS, approximately 18.4%. The top 100 hold roughly 8.27 billion, approximately 31%. And the top 1,000 control around 12.54 billion KAS, about 47% of all circulating KAS. It's a power law tale, a long, flat base, then a steep climb.
And that's ownership. What about dominance among the largest holders? The report uses the HHI, the Herfindahl-Hirschman Index, to quantify it, right?
Exactly. HHI squares the market share of each entity and sums them, so bigger holders count disproportionately. Among the top 50 entities, the HHI comes out to roughly 3,150. In antitrust terms, anything above 2,500 is highly concentrated. So Caspa's ownership structure, among the whales that matter, is firmly in concentrated territory.
Let's do the loop. Explore, data, react, explain, implicate. This time on HHI. Explore. What are we measuring?
We're measuring the gravitational pull of the biggest holders. HHI captures how much the top entities dominate the market for the coin. Here, the share of circulating supply at the entity level.
Data?
HHI approximately 3,150 for the top 50 entities.
Wow, so we're above the antitrust red zone.
Right. Analogy. Imagine a city where the top 50 landlords own most of the apartments, but the top few own entire neighborhoods. HHI tells you that if even a handful coordinate, they can bend the rental market. In coin terms, a handful of whales can bend supply available to trade.
Implicate. Second-order effects?
Market manipulation risk doesn't require overt collusion. It only requires aligned incentives. High HHI means aligned actions from a few entities, like rotating supply onto exchanges, can create the appearance of broad selling or buying, moving price. Liquidity providers then adjust spreads. Slippage rises, and the tail wags the dog.
Mini summary on Theme 1. Wealth is concentrated at the entity level, with a Gini of 0.89 and an HHI of approximately 3,150 among the top 50. The top 100 hold approximately 31% of supply. The top 101,000, about 47%. That concentration translates into outsized market influence and fragility in price discovery. Alex, let's move on. Theme 2. Whale behavior and market dynamics. The report profiles different whale archetypes. Lay them out.
3 archetypes dominate. First, early miners. Their on-chain histories run back to late 2021 and into 2022, mostly mining payouts, very few external purchases. They tend to sit tight, then do large, infrequent transfers, often to exchanges, near local tops. Second, exchange custodians. Unmistakable traffic patterns. Thousands of addresses, constant inflows and outflows of all sizes. Third, modern ASIC operators who are also active traders. Large mining rewards in, frequent movements to and from multiple exchanges, and high transaction velocity. They're managing cash flow and taking tactical positions.
The report's case study of a large, non-custodial entity, the early miner, is interesting. Steady accumulation during drawdowns, rare outflows timed near local tops. Translate that into risk.
It's the classic patient whale. Low-cost basers, long-term conviction, and the luxury of waiting. That's not inherently bad, but when such an entity decides to move, it's a tidal wave, not a ripple. The market can't tell if it's strategic distribution or a regime change until after the fact.
Then there's the trading whale archetype, the one that rotates tens of millions of KAS to exchanges ahead of price drops. Walk us through that pattern.
You see big tranches, 10 to 20 million KAS, flow into exchange deposit addresses. Within 24 to 48 hours, price declines accelerate, and perpetual futures get liquidated, often long positions. Open interest is high, so the setup is ideal for a shove. After the cascade, you see large withdrawals from exchanges back to cold wallets. It's the rinse and reload. Push price down, trigger forced sellers, buy discounted coins. Not every spike is engineered, but the correlation between large whale transfers and short-term volatility is statistically significant.
Okay. Explore data, react, explain, implicate. This time on liquidity-at-risk. Explore. What are we measuring?
Liquidity-at-Risk, or LAR, models what happens if a top whale sells a fraction of their holdings against the current order book. It's essentially, is the buy-side depth within a reasonable price band big enough to absorb a whale's clip?
Data.
Using the top non-custodial whale at approximately 300 million KAS, a 10% sell, so 30 million KAS, against aggregated buy orders within 5% of the market price yields an LAR of 1.85.
That's surprising. Above 1 means the sell order is bigger than the entire buy-side depth in that 5% band, right?
Exactly. Analogy. You're pouring a bucket of water into a shallow gutter. If the bucket's bigger than the gutter's capacity, it overflows. Water rushes out the sides. In markets, that overflow is slippage and cascading liquidations.
Implicate. Second-order effects?
If one whale can wipe out 5% of the book with just 10% of their holdings, you get self-fulfilling spirals. Liquidity providers widen spreads, traders front-run expected dumps, and risk managers tighten leverage. Over time, that dampens organic participation because nobody wants to be exit liquidity. It also means good news struggles to translate into sustainable upside, because structural sell triggers sit above shallow liquidity.
Before we transition, let's do a concrete user-level scenario. Say I'm a long-only holder using spot. What's the playbook if LAR is high?
You size positions smaller relative to your risk tolerance, and you avoid chasing green candles in thin markets. You stagger entries and exits. You keep dry powder, stablecoins or fiat, to buy forced selling if you believe long-term. And you watch whale flows and order book thickness. If the book's a puddle, you plan like it's going to splash.
Mini summary on Theme 2. Whales divide into patient early miners, custodial hubs, and active trader miners. Large exchange inflows tend to precede volatility spikes, and a high LAR 1.85 here signals fragile liquidity, where a single whale can overwhelm the buy side. The result is a market prone to abrupt, self-reinforcing moves. Theme 3. Mining centralization and network security. Start with the top line. Where's the hash rate?
The top two pools, F2 pool and Hum pool, together account for a majority of known hash rate, north of 56%. Add in via BTC, and you're near 3/4. The mining pool HHI sits around 2058, moderately concentrated, but the Nakamoto coefficient for mining is just 2. Translation: 2 entities colluding could meaningfully disrupt transaction ordering and confirmations.
Explore, data react, explain, implicate on the Nakamoto coefficient. Explore. What are we measuring, and why is it a big deal?
The Nakamoto coefficient is the minimum number of independent entities you'd need to collude to compromise the network's consensus, say, to censor transactions or attempt a double spend. The lower the number, the more brittle the system against collusion.
Data?
2. That's the number today for Caspa's mining layer.
Wow. So 2 phone calls is all it takes, at least in theory.
Right. Analogy. Imagine a town where 2 substation operators power the whole grid. Most days, it's fine. No incentive to shut it off. But if both got the same request, suddenly, it's lights out. In practice, economic disincentives matter. Attacks nuke future revenue and hardware value. But geopolitical coercion or regulatory capture are real threats if operators sit in a small set of jurisdictions.
Implicate. What cascades out of a low Nakamoto coefficient?
3 things. First, censorship risk. Selective confirmation slowdowns can freeze targeted flows. Second, confidence risk. Fear alone can widen spreads and drive users to custodial bridges or off-ramps. Third, miner custody risk. Pools temporarily custody newly minted KAS before payouts. A pool breach or seizure hits thousands of miners and can trigger forced selling or a hash exodus, which then concentrates hash rate even further. It's negative flywheel risk.
Now let's pair that with miner economics. The report models revenue and cost. Give us the setup, because this part stings.
One simplifying assumption in the model is a block per second cadence for revenue math, paired with the current block reward, on the order of 4 plus KAS. On that basis, daily minted KAS is roughly 377,568. At a spot price, around 8 cents, that's approximately 30,500 USD in new coin revenue per day. Now layer in an estimated network hash rate in the hundreds of pH per second, mapped to a fleet of mid-range Kaspa-specific ASICs pulling around 3 kilowatts each. Total power draw, in the neighborhood of approximately 100 megawatts, implies daily electricity costs around $190,000 at 8 cents per kilowatt hour.
So costs of roughly $193,000 against revenue of about $30,000. That's not just a gap. That's a canyon.
Exactly. Some miners do better. Contracted power, stranded energy, cogen heat reuse, fee spikes during on-chain booms. But as a baseline, it implies many miners must regularly sell significant KAS just to keep lights on. That's structural sell pressure, independent of price, independent of sentiment.
Let's run the Explore Data React Explain Implicate loop for the miner sell pressure index. Explore. What are we measuring?
MSP estimates how much of daily trading volume must be soaked up by miner selling to cover network-wide costs. It's the daily cost in USD divided by the coin price to get KAS needed over daily traded KAS.
Data?
With the cost and price inputs we just used and average daily volume around 460 million KAS, MSP clocks in at about 18.5%.
18.5%. Nearly 1/5 of all volume just to pay electricity bills.
Analogy. Picture a river that evaporates 18.5% of its flow every day before anyone can drink it. Towns downstream must compete for what's left. In markets, that evaporation is forced sell-through. Liquidity takes the punch first, price takes it second.
Implicate?
Sustained uptrends become harder without fresh demand. Rallies either coincide with fee spikes, rising volume, or external capital inflows. If neither shows up, the river evaporates and price reverts. It also means unexpected volume dips. Holidays, risk-off weeks hit harder because the fixed cost drumbeat doesn't stop.
Mini summary on Theme 3. Hash rate is concentrated. Two pools can theoretically collude to disrupt consensus, while miner economics inject a constant headwind. The Nakamoto coefficient is 2, and the MSP is approximately 18.5%. That combination raises both security and market structure risks. Theme 4. Custodial concentration and systemic risk. This one isn't as intuitive, so start with the Explore. What exactly is the Custodial Concentration Risk Index measuring?
CCR asks, how much of the liquid circulating supply is pooled on centralized exchanges, adjusted for how trustworthy those venues are? The more that sits on a small number of exchanges, especially lower trust ones, the more a single operational failure, hack, or regulatory seizure can yank liquidity out or flood it in.
Data?
CCR calculates to about 0.42 on a 0 to 1 plus scale, which the report buckets as moderate. Below 0.25 is low, 0.25 to 0.50 moderate, 0.50 to 0.75 high, and above 0.75 critical.
That feels like a relief compared to LAR and MSP. Moderate sounds manageable.
It's better than high, but there's nuance. Analogy. Imagine storing community grain in 3 silos run by different companies. If one burns down, you can still feed the town, but prices will spike and people will panic. CCR says the silos aren't all in one place, but losing even one still hurts.
Implicate?
A mid-tier exchange incident can lock up withdrawals or dump collateral. If that exchange is a primary venue for Caspa liquidity, market makers on other venues widen spreads, retail steps back, and whales gain relative influence. Also, don't forget miner as custodian. Pools temporarily custody block rewards. A pool incident is like a surprise tax on future sell pressure. Some miners are wiped, others must sell more to continue operating.
So, users should care because custody risk is contagious. Operational problems in one corner of the ecosystem migrate into pricing everywhere.
Exactly. And as Kaspa's DApp landscape grows, there's a chance to build more non-custodial rails for liquidity that diversify this risk. But we're not there yet at scale.
Mini summary on Theme 4. Custodial concentration sits at a moderate level, CCR 0.42, but it's still a single point of failure vector. Exchange or pool incidents can ripple across price, spreads, and confidence, especially in a market with thin order book depth and large whales. Let's explicitly revisit the Explore, Data, React, Explain, Implicate loop for a few other staples the report touches, so listeners can internalize the signal. Explore. The chromatic emission schedule. Why does it matter?
It sets expectations. A smooth, geometric monthly reduction means predictable inflation decay. Predictability helps miners plan CapEx/OpEx and helps markets price supply changes. No sudden cliffs, fewer shock cycles.
Data?
Emission halves annually. implemented as smooth monthly steps rather than discrete epics.
React. That's clever. Less whiplash than a hard cut having.
Explain. Think of dimming a light with a dial, not a switch. You notice it getting darker, but there's no instant jolt. Markets like dials.
Implicate?
Smoother emission helps, but it doesn't erase minor sell pressure or wealth concentration. It's a better runway, not a magic wand.
Explore. Network throughput. 10 blocks per second. Near instant settlement. Why is that a double-edged sword?
Speed and low fees are great for users and scaling, but they also lower the cost of complex, high-frequency strategies. If whales and market makers can cheaply reposition tens of millions of KAS, they can amplify patterns, spoofing, momentum ignition, more economically than on slow, expensive chains.
Data?
We've seen single-day transaction waves in the tens of millions when the ecosystem heats up. KRC 20 days were outliers, but instructive.
React. So the highway helps everyone, but semi-trucks benefit disproportionately.
Explain. Exactly. If you're driving a compact car, the highway is fantastic. If you're driving a convoy of semis, it's transformative. The bigger you are, the more you can exploit the lanes.
Implicate?
Without counterweights, deep liquidity, robust non-custodial markets, diversified mining, the semis own the road.
Part 5. Synthesis. Alex, what's powerful here is how the findings link. How does wealth concentration directly feed into the network security and liquidity risks we discussed?
Start with wealth. A 0.89 Gini and HHI, approximately 3,150, mean a handful of entities can alter the float on short notice. That instantly interacts with liquidity. When LAR greater than 1, a single whale clip can exhaust the buy side within a narrow band. Those two together increase the payoff to strategic timing around leverage and sentiment. On the security side, concentrated hash rate, Nakamoto coefficient of 2, doesn't automatically produce censorship, but it reduces the margin for error. If a pool incident occurs while whales are rotating supply, you get a compound shock, degraded trust, widening spreads, and a dash for liquidity that the order book can't provide. Layer miner economics on top, MSP approximately 18.5%, and you've got a constant drain that must be countered by new demand. In that environment, whales are de facto macro actors. Their movements aren't just trades, they're policy decisions for the market, because the infrastructure and liquidity are tuned to magnify them. The through line is simple. Concentration in one layer increases fragility in the others. Decentralization isn't a checkbox, it's a stack, and the stack's resilience is gated by its most centralized layer on any given day.
Part 6. The so what? Broader lessons for the industry. Stepping back from Kaspa specifically, what does this case teach us about protocol design, incentives, and the red flags investors should watch?
First, decentralization must be measured, not assumed. Fair launch and elegant consensus are necessary but insufficient. You need active metrics, entity-level Gini, HHI, CCR, LAR, MSP, and a live Nakamoto coefficient to track the system's health as it evolves. If your dashboards can't answer how many actors can move this market in a day, you're flying blind. Second, mining economics dominate proof-of-work realities. Hardware commoditizes, capital concentrates, power arbitrage rules. If your security model assumes many small miners, but your ASIC roadmap rewards industrial scale, you will drift toward concentration unless you counter-design through better pool decentralization, incentives for solo mini pools, or innovations in payout schemes that reduce pool power without destroying miner predictability. Third, liquidity is infrastructure. Order book depth, market maker diversity, and cross-venue connectivity are as critical as consensus throughput. A chain can settle in milliseconds and still be brittle if a single whale can drain the book.
Protocol ecosystems should cultivate non-custodial liquidity venues, incentives for on-chain market making, and mechanisms to reduce reliance on a small set of centralized exchanges.
Fourth, beware efficiency flips. Speed and low fees are incredible for user experience, but also lower the cost of adversarial or extractive strategies. Designers should assume sophisticated actors will exploit every affordance. Rate limits, anti-MEV designs adapted for DAGs, or settlement layer guardrails can mitigate the worst abuse patterns without neutering performance. Fifth, investors need a risk checklist that's more than vibes. 1. Who are the top 100 entities by clustered supply, and how much do they control? 2. What's the mining Nakamoto coefficient, and how jurisdictionally diverse are those entities? 3. What's LAR under plausible whale clips? 4. How high is MSP under conservative power price assumptions? 5. How distributed is custody across exchanges with independently verified reserves? If you can't answer those in a few minutes, you're speculating, not investing. Finally, transparency compounds. Open, regular publication of these indices and community pressure to improve them creates positive externalities. If a project publicly tracks and drives its CCR down, its LAR below 1, and its Nakamoto coefficient up, capital notices. Healthy metrics aren't just safer, they're bullish.
Part 7. Concluding Thought Provokers. Let's leave our listeners with questions they can take to their teams, their communities, and their portfolios.
Here's a set to chew on. If decentralization is a stack, which layer of your favorite network is the real bottleneck today? Ownership, liquidity, or hash rate? And what concrete steps could raise its Nakamoto coefficient in the next quarter? If one entity can sell 10% of their holdings and overwhelm the top 5% of the order book, what design, market making, or incentive changes would cut that liquidity at risk below 1 without sacrificing usability?
If miner economics requires selling nearly 1/5 of daily volume, what non-speculative demand, fees from real usage, not hype, could sustainably offset that? Are there product-market fits on the horizon, or just narratives? If two mining pools can collude to disrupt consensus, what is the credible path to a coefficient of 3 or 4? Could we create incentives for small pools or redesign payout mechanisms to reduce central points of custody and control?
If the top 100 entities control roughly a third of supply, how might you diversify the holder base? Could staking-like mechanisms for POW ecosystems, reputation systems, time-weighted participation rewards, or non-transferable contribution tokens nudge behavior toward broader distribution without undermining monetary policy? If custody is moderately concentrated, do you have a plan for an exchange-specific incident? What is the community's circuit breaker for trust? Public proof of reserves, on-chain market maker backstops, or pre-agreed emergency liquidity programs?
And finally, are we comfortable calling a network decentralized when the social layer still depends on the restraint of a handful of whales and pool operators? If not, what would you need to see in data to change that answer?
Powerful questions to end on. That's all the time we have for this edition of Deep Dive Tech. Thanks for tuning in.